Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden stories within financial filings. Today, we're diving into something that smells like a big money deal for COPT defense properties, and we'll see if it is a slam dunk or just a whiff. Alright, let's get straight to it. COPT Defense Properties, or CDP as they reknown on the New York Stock Exchange, has filed a Form 8K report. Now, an 8K is like a Company S public diary entry for significant events that happen between their bigger quarterly or annual reports. Think of it as a company saying, PSST, something important just happened and you need to know. So, what is the big news on the 23rd of September of 2025? The Company S operating arm CDPLP and the parent company CDP signed an underwriting agreement. This is basically a contract to sell a whole bunch of new debt. We are talking about a massive $400 million worth of senior notes, which are basically loans that the company is taking out. These loans are due in 2030 and carry a fixed interest rate of 4.500%. It is good to see they are locking in rates before they potentially go up. Now, to sell these notes, they used a pre-approved plan with the SEC called a shelf registration statement. This is like having a permit ready to go in case they decide they need to raise money quickly. They also filed a prospectus supplement to give all the nitty-gritty details to potential investors. This was actually filed with the SEC a couple of days after the agreement itself on the 25th of September. So the wheels were already turning for this major deal. Here is a crucial point for anyone thinking about investing in these notes. The parent company CDP is fully backing these loans. Fully and unconditionally guaranteed. Means if CDP can pay back the debt, CDP steps in and pays it back. This makes the notes a lot safer for investors. The deal is expected to wrap up around the 2nd of October, 2025. Now, every big agreement like this comes with a whole lot of legal fine print. The underwriting agreement is no exception. It outlines all the promises each side is making, the conditions that need to be met for the deal to actually happen, and what happens if things go wrong. It is standard stuff, but it ensures everyone is on the same page and protected. To add a bit more color to this story, the company also put out a press release about the pricing of these notes. This is often where companies try to put a positive spin on things, so it is always worth looking at. But remember, the actual filings give you the unvarnished truth. The report also lists the key exhibits, which are like the supporting documents for this filing. We've got the underwriting agreement itself, and that press release we just mentioned. Plus there is the interactive data file for the cover page, which is important for the folks who build those automated systems that scan these reports. It's worth mentioning that CDP's common stock, represented by the ticker CDP, is traded on the New York Stock Exchange. This debt issuance is a move by the company to finance its operations or perhaps new ventures, and it directly impacts the company's financial structure without immediately diluting existing shareholders. Ownership like issuing more stock would. Now, let's look at this from a strategic perspective. Companies like CDP Defense Properties, which likely deal with real estate or infrastructure related to defense, need capital to acquire properties or perhaps develop new facilities. Issuing senior notes is a common way for established companies to borrow money. They are getting $400 million, which is a pretty significant sum. The fact that the parent company guarantees it shows confidence from the leadership and provides security to the lenders. This signals that CDP believes it can generate enough cash flow from its existing or future operations to comfortably service this debt and eventually pay it back. Given that this is essentially a debt financing activity, there aren't detailed financial statements like you defined in a quarterly report. We don't have revenue figures or profit margins that we can dissect here. However, the very act of borrowing such a large sum indicates continued business activity and a need for capital. For a company in the defense property sector, this could mean they are eyeing expansion, acquiring key facilities, or investing in upgrades to meet the demands of their clients, which are likely government defense agencies. The 4.5% interest rate on these notes during 2030 seems quite reasonable in the current market, although we don't have the exact date of the filing S context to compare it to. Locking in this rate for a relatively long term provides predictability for the company S interest expenses. This is generally a sign of sound financial planning. It suggests they assess their future cash flows and are confident that paying this fixed rate will be manageable. What are the risks here? Well, all debt carries risk. If the company's business performance takes a downward turn, servicing this $400 million debt could become a burden. However, the guarantee from the parent company CDP mitigates some of that risk for the note holders. For CDP itself, the risk lies in over-leveraging. If they take on too much debt relative to their earnings capacity, it can strain their financial health, making it harder to operate and invest in new opportunities. Looking at the bigger picture, this move by CDP seems to be a proactive step to secure funding for growth. It is not a sign of distress, but rather a strategic maneuver. For investors holding CDP stock, this means the company is investing in its future, which could lead to increased asset value and cash flow down the line. However, it also means managing a larger debt load. In conclusion, this 8K filing is a straightforward announcement of a significant debt issuance. COPT Defence Properties is raising substantial capital through senior notes, backed by the parent company. It points towards a strategy of expansion or strategic investment. The 4.5% interest rate is competitive, and the long maturity offers stability. On the downside, it increases the company S leverage, which investors should always keep an eye on. The company S ability to generate consistent revenue from its defense. Related properties will be key to its long-term success in managing this new debt. What is your take on companies taking on large debt to fund growth like this? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe to Corporate Decoder for more in-depth financial analysis. Also, join our thriving Discord community linked in the description for more insights and discussions. Thanks for watching, and I'll see you in the next one.